The tape is weaponizing fear to trap emotional capital at the exact moment institutions are recalculating risk models. This is not a drill. This is a live structural shock. The United States and Israel launched a coordinated attack against Iran's nuclear infrastructure. Iran retaliated instantly. Shipping oil and critical reserves are now effectively closed off from the rest of the world. The baseline timeline for the ongoing conflict is expected to last another 4 weeks. Look at the immediate data. That is the cost of physical panic. Projecting oil to $130 per barrel under prolonged closure conditions. The informed minority understands what comes next. The mainstream consensus assumes this is a permanent breaking point. It is not. The ones who verify the data know that geopolitical escalations are mechanical triggers. While the momentum chasers run for the exits, the smart capital is isolating the algorithmic bid. The mainstream consensus assumes the sky is falling. They are projecting a permanent global recession based on a regional conflict. Retail traders look at the red on their screens and see chaos. Short-term price action dictates a mechanical flush, not an apocalypse. The ones who verify the data understand that markets do not move on headlines. They move on liquidity. Look at the calendar. The structural reality is that February and March historically represent the weakest seasonal tape of the entire year. The momentum chasers are confusing a predictable seasonal liquidity vacuum with a structural collapse. They are selling into the exact window where smart capital expects weakness. Zoom out to the cycle. We are in 2026, a midterm year. The data is explicit, not theoretical. Since 1950, the historical average intro-year pullback defining midterm years has been 17.5%. Compare that to the baseline comparison data. Standard year pullbacks max out at just 11 to 13%. That 17.5% is not a random number. It is the exact standard deviation of election cycle drawdowns, when retail panic sells the $130 oil headline. Institutions absorb the supply at these precise historical levels. The informed minority is not reading the homepage of a news site. They are mapping the 17.5% drawdown vector. They are waiting for the exact technical levels to hit. The algorithms are resting their bids precisely where the historical midterm cycle dictates the capitulation ends. This is not a market breaking. This is a market breathing. It is a mechanical flush designed to separate weak hands from their capital. The tape is weaponizing the geopolitical fear to trigger stop losses, clear out the leverage, and reset the board. Zoom out for a moment. The physical constraint of a blocked transit lane is absolute. Yet the aggregate equity market response represents a statistical anomaly. This is not a generalized economic collapse. It is a specific, localized commodity supply destruction. The divergence between those two realities creates a supreme asymmetric setup for any emotional capital. Look at the map. The Strait of Hormuz is not a headline. It is a physical bottleneck separating the Persian Gulf from the open ocean. It is surrounded by nations producing half of the world's oil. The physical reality is that 1/5 of the world's oil supply and 1/3 of global natural gas pass through this specific maritime choke point daily. The transit lane is only 2 miles wide, and parts of it fall directly within Iranian territorial waters. Iran never ratified the United Nations Transit Agreement. They have the geographic leverage to choke the supply line, and they are threatening to use it. If those shipping lanes close, 15 to 18 million barrels of daily oil capacity are structurally at risk of immediate removal. Now the domestic ledger. The United States domestic deficit is mathematically rigid. We consume nearly 20 million barrels daily, making us the #1 global consumer. Yet we isolate our production at exactly 18.6 million barrels. That delta creates a hard reliance on external supply. When the strait shuts down, shipping costs explode. Raw material production prices rise, and transportation becomes immediately more expensive. The mainstream media conflates this localized input stress with a permanent zero-bid equity market. They are wrong. The retail crowd is dumping their entire portfolio's equities, tech, healthcare, because crude is spiking. They are conflating an energy supply shock with a systemic market failure. That is not how financial warfare operates. A physical transit constraint isolates the pain. It does not distribute it evenly across every asset class. A blocked strait in the Middle East does not erase the structural forward earnings of domestic megacap equities. Institutional capital understands this mechanical isolation. The algorithms are programmed to recognize the difference between a global liquidity crisis and a localized maritime blockade. Verify this yourself. The reports are public. The flow of global shipping is tracked in real time. The U.S. energy deficit figures are published daily. The ones who verify the data see an isolated energy crisis being mispriced by emotional retail traders as a systemic equity failure. The informed minority is fading the broad market panic. They are using the retail liquidity event to position for the inevitable stabilization of assets, entirely disconnected from the Strait of Hormuz. Now the macro escalation. The mainstream is panicking about World War III. They are liquidating generational wealth into cash, paralyzed by the headlines. The informed minority is tracking the Federal Reserve constraint metric. State-level forces are reallocating massive capital streams amidst the conflict. Yet historical data proves kinetic escalations routinely mark generational equity bottoms. The actual macro threat is a prolonged central bank paralysis, not a permanent zero-bid equity market. This is not a market destruction event. It is a risk repricing channel. When state-level actors escalate kinetic conflict, capital does not evaporate. It relocates. Look at the mechanics of the central bank trap. The Federal Reserve constraint metric is explicitly defined. The Federal Reserve estimates that for every $10 a barrel increase in crude oil prices, the system absorbs an immediate 2% spike in inflation. That is the mathematical trigger. The Fed then gets stuck in a trap. They cannot lower interest rates if inflation persists, but if the broad economy declines under the weight of energy costs, they will need to lower interest rates to support it. That is not a policy error. That is a classic case of stagflation. The momentum chasers cannot model this. They see oil spike and assume an immediate equity crash. They ignore the currency flows. Historically, the US dollar actually tends to get a lot stronger during times of economic crisis. It is the world's reserve currency and functions as an immediate flight to safety. That specific flight to safety into the dollar could actually push Treasury yields down in the near term and reduce mortgage rates. The capital rotates. It seeks the path of least resistance. Do not let the tape blind you to the historical baseline. The retail crowd sells the invasion. The algorithmic bid buys the recovery. We have the historical aggregates. Throughout history, during every major geopolitical event since World War II, prices are on average 5% higher 6 months later. That is not a theory. That is a documented statistical reality. The absolute historical baseline dictates that every geopolitical event in history has so far been followed by a stock market increase. The institutions know this. They are not trading the emotional noise of the Strait of Hormuz. They are executing ruthless capital deployment based on 80 years of aggregate market data. They know that kinetic escalations force weak hands to surrender assets at a discount. The algorithms do not feel fear. They buy the historical baseline. The ones who verify the data are front-running the inevitable 6-month recovery vector, positioning their capital exactly where the fear is highest. Now the honest case for caution, because balance is what separates analysis from promotion. The historical rebound thesis fractures strictly if the kinetic shock transitions from a transit blockade to permanent infrastructure destruction. We quantify the exact thresholds where the geopolitical risk premium degrades into a structural economic failure. Look at the theoretical pivot. The risk is targeting oil wells and production directly. That is not delayed transit. That is permanent supply destruction. A blocked strait is a logistical bottleneck. A burning oil field is a structural wipeout. If that pivot occurs, the inflation math turns violent. The pass-through rate is mechanical. A 5% oil price increase adds exactly 0.1 percentage points to average inflation. That is not a trailing indicator. Most of that pass-through happens within 4 weeks. The Federal Reserve cannot cut rates into a 4-week localized inflation spike. Then the secondary catalyst hits. Food inflation. The Strait of Hormuz is not just an energy choke point. It is a primary pathway for fertilizers. North American food inflation is already baseline projected at 4.3% in 2026. A fertilizer transit failure accelerates that figure aggressively. That destroys household budgets. It crushes consumer spending. The feedback loop triggers, slowing the economy while inflation persists. This is not a standard pullback. This is a structural failure threshold. If the kinetic shock transitions from shipping reroutes to missiles hitting production wells, the historical midterm cycle bounce fails. The geopolitical premium flips from a buying opportunity into a permanent drag on GDP. The informed minority respects this threshold. They size positions, knowing the difference between a temporary liquidity drain and a permanent physical deficit. Mechanical liquidation is ending. The mathematical data dictates a high probability mean reversion following the current mechanical liquidation. Capital preservation demands fading the retail panic. It demands executing ruthless risk management and positioning directly for the statistical midterm cycle bounce. This is not a guess, this is probability mathematics. Look at the exact metrics. The historical absolute is undeniable. 1 year off midterm lows has never seen the stock market close lower than the bottom. Never. The 12-month return vector following a midterm year bottom average is exactly 31.7%. The variance is minimal. You are looking at a 68% statistical probability of 1-year returns printing at 30% or more following the defined pullback. Retail is liquidating into a historically verified wealth generation window. The informed minority is not acting on geopolitical fear. They are executing against a 68% probability threshold. Verify the midterm cycle data yourself. The historical aggregates are public. This is financial warfare education, not advice. Invest with logic, not hype.